If Bitcoin is supposed to be digital gold, why did it drop when fear hit the markets?
And if you've invested in Bitcoin, well, yesterday was probably not the day for you. The value of Bitcoin plummeted. At one point, it was selling for under $61,000, and that's now half of its all-time high of more than $126,000, which was reached
in 2026. Gold climbed past $5,000 because investors wanted safety. Bitcoin struggled below $90,000 because investors treated it like a risky bet. Not because Bitcoin failed, but because Bitcoin moves when money flows in and out, not when people look for shelter. In this video, we'll break down what 2026 is revealing beneath the surface. The macro forces shaping investor behavior. How institutions allocate during stress. Why volatility changes an asset's role inside portfolios, and what this divergence teaches about risk management. What if Bitcoin isn't broken, but simply isn't built to rise for the same reasons gold and silver do? Let's begin with what Bitcoin actually is. Bitcoin is a digital asset, computer code that exists only online, that was created as a peer-to-peer alternative to traditional money. It was meant to let people send value without banks holding the keys. But over time, most people stopped using it to buy things and started holding it because they hoped it would go up in price rather than because it was useful for everyday payments.
Look, Josh, there's a lot of pressure on Bitcoin at the moment. As you mentioned, we're down more than 40% from the prior all-time high above 125,000. And so there is pressure on Bitcoin right now. I think part of that pressure is coming from gold taking the spotlight and other commodities taking the spotlight. And I think the other element of this is that we are just in the midst of a Bitcoin bear market. We've actually been in a bear market now for many months, probably more closer to a year. And so I think that's what's keeping Bitcoin down. We've now seen it kind of drawing down the most over that period overall. But nonetheless, it's a bear market. It's a bit dark right now in the crypto space, but we think there's brighter times ahead.
In early 2026, Bitcoin has stayed below key resistance levels even as gold hit new records. And its price has been weaker, reflecting how traders are pricing risk and liquidity differently right now. Instead of acting like a refuge in uncertainty, Bitcoin has often moved with other growth assets like tech stocks, rising when optimism returns and falling when stress rises. That's because large investors, including ETFs and institutional funds, treat Bitcoin more like a growth tool than something to shelter under during storms. Here's the thing. When big investors feel nervous, they sell what moves the most and what they can sell quickly. Bitcoin fits both. Gold doesn't. That doesn't mean Bitcoin is broken. It means Bitcoin is doing what assets like it usually do under pressure, not what the digital gold label suggested. Bitcoin didn't fail in 2026. Expectations around it changed faster than reality did. Gold and silver aren't going up in 2026 because people think they'll suddenly get rich. They're going up because investors are looking for safety when things feel uncertain. In early 2026, gold topped around $5,280 per ounce, a record high as more money flowed into precious metals, while Bitcoin struggled to reclaim key levels like $90,000. Gold and silver are being used like a seatbelt. You don't wear a seatbelt because it's exciting. You wear it because if something goes wrong, you want it there. This pattern shows up again and again in history. When governments borrow a lot, when prices rise fast, or when political uncertainty increases, people stop chasing the best return and start looking for the safest place to put their money. Gold and silver aren't tied to a company, a profit report, or new technology. They just exist, and that's exactly why they're dependable in bad times.
The gold and silver metals, the precious metals within the broader commodities space, they're clearly known to be stores of value. So that was their traditional role many hundreds of years ago, and that still stands true today. So people are looking for a store of value. We're seeing depreciation in the U.S. dollar. There's some rotation out of U.S. assets more internationally, but also a function of that is more investment in gold. So people are looking for that store of value, that safe haven, and gold fills those roles.
Another reason these metals do well is trust. Big banks, governments, and central banks hold gold as part of their reserves. That's like everyone knowing a particular food won't upset their stomach. It might not be thrilling, but it's reliable. Gold and silver also don't jump around in price as much as other assets, which helps calm nerves when markets feel shaky. Most importantly, gold and silver don't need a story to explain why they matter in a crisis. People have seen them work before. So when confidence starts to disappear, money doesn't chase exciting ideas. It moves toward things that have already proved they can handle stress. This is how money acts when it wants protection, which is exactly why Bitcoin's behavior in 2026 caught so many people off guard. By 2026, the tension around Bitcoin isn't really about price. It's about roles. For years, Bitcoin was called digital gold. But inside real portfolios, it hasn't been treated like gold at all. And markets are very strict about that difference.
Yeah, so, first of all, they're different assets. I think they're bought by different people for different reasons. So trying to compare them like moving in lockstep doesn't really make any sense. And if you look at them historically, they don't. They don't work in lockstep. They almost work opposite of each other.
When markets come under pressure, institutions don't argue about narratives. They sort assets by job. Some are meant to protect value. Others are meant to grow it. Bitcoin, especially after the rise of ETFs and institutional ownership, has mostly lived in the growth bucket, alongside tech stocks and other risk-sensitive assets. That matters because risk models penalize volatility. Assets that move a lot require more capital, tighter controls, and faster adjustments. Bitcoin's upside potential, the very thing that makes it exciting, also makes it harder to hold defensively. Big swings are great in calm markets. In stressed ones, they become a liability. So when pressure builds, portfolios don't follow stories. They follow structure. Gold stays where it is. Bitcoin gets treated like what it's been acting like. And that's where the gap between expectation and reality finally shows up. So what happens when an asset is treated like protection, but behaves like growth when stress arrives? 2026 turned theory into reality. Markets applied pressure, and portfolios responded in ways many investors weren't prepared for. Gold behaved predictably. It stayed steady when conditions tightened. Bitcoin didn't. It forced a reassessment, not because it collapsed, but because it reacted like a risk asset when protection was expected. For many investors, the surprise wasn't the movement itself. It was what that movement revealed. Assumptions that felt reasonable during calm periods no longer held once volatility returned. Assets chosen for safety introduced uncertainty instead. Finance has a simple rule that shows up again and again. A strategy that only works in good times isn't a strategy. It's a bet. When liquidity is abundant, that distinction is easy to ignore. When conditions change, it becomes unavoidable. What this period exposed wasn't a broken market or a failed asset. It exposed a mismatch between belief and risk management. Markets don't punish assets for being volatile. They punish investors for expecting stability from something that wasn't built to provide it. That surprise wasn't bad luck. It was the system doing exactly what it always does. When markets get stressed, money follows a very predictable path. First, people get unsure about the future. Then they want easier access to their money. Finally, they try to avoid big price swings. This sequence shows up in almost every major financial shock, including 2026. Gold benefits from this structure. It has been traded for thousands of years, is held by central banks, and is accepted almost everywhere in the world. Its price usually moves slowly compared to stocks or crypto. During stress, stability matters. Investors don't buy gold expecting it to double. They buy it expecting it not to surprise them. Bitcoin works differently. Its price can move several percent in a single day. It trades 24 hours a day and reacts quickly to changes in interest rates and liquidity. When central banks keep money cheap, Bitcoin tends to rise. When money becomes tighter, Bitcoin often struggles. That's not an opinion. It's visible in its past correlations with risk assets during stressed periods. The mistake in 2026 wasn't how these assets behaved. It was expecting two very different structures to respond the same way. Assets built for stability protect confidence. Assets built for growth depend on it. When conditions change, those differences stop being theoretical and start shaping real outcomes. So what do you actually do with this information without putting your portfolio at risk? 2026 exposed a quiet mistake many investors didn't realize they were making. They weren't holding the wrong assets. They were asking the right assets to do the wrong jobs. When stress arrived, portfolios didn't fail because markets were unfair. They failed because expectations didn't match reality. Every asset in a portfolio needs a clear role. Some are there to protect. Others are there to grow. Problems start when one asset is expected to switch roles in the middle of a crisis. That's like expecting your umbrella to suddenly turn into a heater when it gets cold. Useful items. Wrong job. Another hard truth showed up quickly. Correlation matters more than conviction. Two assets can have completely different stories and still fall at the same time. When fear hits, investors don't sell based on belief. They sell based on overlap. If assets move together during stress, they stop protecting each other. Volatility adds another hidden cost. Big swings don't just change account values. They change behavior. They create anxiety, force decisions, and trigger selling at the worst possible moment. Calm assets are easier to hold when emotions are high, which is why they matter more than they seem. When fear spreads, liquidity dominates. Assets that are easy to sell often get sold first. That's not personal. It's mechanical. This is why diversification based on function works better than diversification based on stories. Markets don't reward narratives under pressure. They reward preparation. What 2026 revealed wasn't a broken asset, but a clearer map. Bitcoin didn't fail. It simply played a different role than many investors expected. Gold and silver did what they've done for generations. They absorbed stress and held their ground. Bitcoin stayed on offense, moving with liquidity, confidence, and risk appetite. The confusion came from mixing those roles. Scarcity alone doesn't create safety. Structure does. Behavior does. When markets tightened, assets responded according to how they're actually used, not how they're described. The takeaway isn't to reject innovation or cling to tradition. It's to match tools to tasks. Growth assets belong where growth is expected. Defensive assets belong where stability is required. Most people only try to understand money after it hurts them. This channel is about learning before that happens. If this video helped you see markets a little clearer, you'll want to be here for the next ones. We break down money, finance, and risk in a way most people never get taught. Hit subscribe so you don't miss what comes next, because understanding this stuff before the next shift really matters. See you in the next one.